Hey everybody, welcome to the Brian Foltis Behavioral Finance Podcast. My name is Dr. Brian Foltis, and I am an Associate Professor of Finance at Butler University in Indianapolis, Indiana. And my goal is to teach you about behavioral finance in order for you to make better life decisions and better decisions with your money. Our podcast today, the topic of the day, is talking more about market efficiency. So this is going to be more of a financial markets kind of conversation. And after this conversation, we move into a whole big segment talking about heuristics and biases. This moves into the psychology side is where we're going to go with this particular content. But in the meantime, we've got one more conversation around challenges to market efficiency and just tying that conversation up in hopefully the least painful way possible for you. If you were here for the psychology, then we can make our way through this. If you do like this content, then there is more to talk about that I can expound on in a future topic. But in the meantime, we're just going to get straight to the content. So one more exercise that I like to do with my behavioral finance class is we do I don't know why this is called a beauty contest. There's nothing beautiful about it, but it's a really cool way of showing how we deal with participants who may or may not be fully rational and how we kind of deal in markets with that. So again, we've already laid out that not everybody is fully rational, but let's just show you how this might work out in markets here. We're going to ask you to give us a number, give an estimate or your guess. It's going to be a number between 0 and 100. Range is 0 to 100. And out of everybody in the group, we're going to take the average of everyone in the group, and the winner is the one guess that is 2/3 of the average of the total group. So 2/3 of the average of the total group. If that average is 50, then 2/3 of that is 33 1/3. Whoever chose 33 1/3 wins in my case, will be $5. $5. But this is just an exercise I want you to think about. It's 2/3 of overall for the group. So I wasted no time busting out my beautiful $1.25 whiteboard. 0 to 100, 2/3 of, and we're even introducing mu here. That is just the sign for average for the group. Okay, so I want you to think about your number. And the last class I had, I think the average number, or the winning number was 21. The winning number was 21. They got the $5. And I think that still gets a cup of coffee at Starbucks, at least for my black Pike. That'll get me like 1.6 of those here in the Midwest. Anyway, 21 was the average number. I said, okay, I thought we were talking about rationality and markets being fully rational and all participants being fully rational. So how does this play into this conversation? So 21 is the average. What do you think if all participants were fully rational? What would be the right number? Before we look at that, sometimes I get people in the group that say 66 or 50. And so let's talk about these numbers here. If you put 66 or higher, well, if you put 70, you've just written yourself out of the game to have any chances of winning, because mathematically, if everyone, even if they give 100 as an answer, for some reason, everyone says 100, the 2/3 would be 66 and 666 forever. And so your number still wouldn't make it. And that's the only chance that anybody with a 66 number would actually have a chance of winning. Everyone posting 100 answer. And we know that's not true. Even with 50, that means the average needs to be 2/3 or 66.7 in order for that to come down to 50. So some of these numbers are really, even if we start with a base, like I said, of everyone just randomly choosing 50, well, then that winning number would be 33 1/3. But now let's think about this rationally. Everybody in the group is thinking about the same thing. And they say, well, wait a minute. If everybody starts at 50 and 33 1/3 is the winning number, then everybody should choose 33 1/3. If that's the case, then 2/3 of 33 1/3 is the real number that I'm looking for. So that would be 22.2. But then you think, wait a minute, what if everyone else thought about that too? Well, then the new number would be 14 and some change. Now you continue on this. How many steps are people willing to think through this? Well, if everyone was thinking 14, then 2/3 of that is roughly 9 or 10. Everyone's thinking 2/3 of that, we're roughly 6 to 7. Continue on. So I am going back to my original question. What if everyone was fully rational, fully thinking through this? Well, in that kind of environment, 0 is the correct number that every single person would get. They would just take that process all the way down to 0. And I would take that $5 and split it among however many people, would split it equally. That would be a perfectly efficient market. And everyone it's priced perfectly. Everyone's in agreement. We spread the spoils. I know it's just $5, but spread the spoils. So I tell the group every time. I tell them about this. 0 is the rational answer. And then I say, guess what? We're going to do this all over again. I want you to do a whole new estimate. $5, another $5 is now at stake. And the same rules apply. You're going to be the winner of the $5 is 2/3 of that average. So what do you say? And so you get, I don't know, a handful out of 30 students. I'll get a handful, 4 or 5, that'll say 0. They say they're really feeling good that they got it right and they're fully rational. But guess what? 25 other people didn't say 0. And those individuals who said 0 never win any money because it's always the number above. In fact, we get it from about 21 down to about 14. So it takes one extra step in that process down to about 14. And that's what typically wins. And so, of course, I've got a bunch of seniors in my classes, and senioritis is a real thing. And so you might have somebody that's out there taking, still pulling a 60 or something, or a little bit higher just to be funny, but that pulls the number up. And so we think about participants in the market and some of this dumb money, and how we still have to kind of deal with this dumb money, knowing that it's out there. And later on in this chapter, we're going to talk about herding and noise trading. So these are kind of the things that we will see. But nevertheless, if 14 is still the answer, that means people with 0, fully rational people, are not making that $5. So anyway, that's the beauty contest. And it's just showing, once again, the extent of information that we're using, and how the assumption that everybody's fully rational, we can just add a little bit more evidence to it that's really not the case. Today, though, we are going to be challenging efficient market hypothesis. Namely, we're going to be challenging the semi-strong market efficiency. So if you remember from a previous podcast, we talked about strong market efficiency where past, present, future, private, and public information is known, this omnipotent that not even we know about anybody else except for ourselves is possible. And that's why we kind of go down to the semi-strong, which is past, present, future is known about every security by all individuals. That's public only. So the only way you're going to beat the market is with private information. And then we said weak is using the price and returns as that's what everybody knows. Therefore, technical analysis is not actually viable to get profits. Well, I actually just wrote a paper not too long ago. It was about a year ago. Got published. Just got number 16 publications, academic peer-reviewed publications. Just had 16. Number 16 was accepted. I am the least likely person to be a 16-time academic finance writer, but I'm proud of that, and worked really hard to develop that kind of skill. And I like being pretty nerdy. I like being the center of attention and teaching people. That's that Scott Redwing lead singer that I've gotten in my personality, but I also like to nerd out. So we found that using a 200-day moving average over the last 20, 30 years to buy and sell kind of the stock market when it goes above and below, that it actually outperforms, albeit very little, but at the same time it reduces your portfolio volatility based on our results. And so we found that interesting because usually there has to be a trade-off. And in this case, we got a little bit of extra returns with reduced volatility, which we found interesting using that. Anyway, like I said, if you're interested in learning more about that, we have a future conversation to dive a little bit deeper into that. If not, we're just going to continue on challenging the semi-strong market. So the only way to beat the market is through inside or private information. So we've got 6 challenges, 2 of which we've already talked about in a previous podcast. Number 1 is small and large cap stocks. So when we group small cap and large cap stocks against each other, we found that small cap outperform large cap. Now, what I'm hoping you should say is, duh, yeah, of course. Small cap is riskier. They should outperform large cap stocks. There's a lot of risk to them. And I would say you're absolutely right. However, even after we factor in the beta risk through the capital asset pricing model, the small caps still outperform the large cap stocks. So small cap, large cap. So if you have that risk appetite, by the way, I'm not a stock tip or strategy tip. I'm just an educator. So there's my disclaimer. But if you were to play this, if this continued on, then you would invest in small caps if you had that risk appetite, because they will outperform even after adjusting for risk over time. Same thing with growth and value stocks. We found out that, believe it or not, historically, value stocks have outperformed growth stocks over time. And in efficient markets, all these stocks should just be perfectly priced, and there shouldn't be any indication of what they're doing, particularly with their dividends. So if you're a growth company, I think of growth stocks as companies like Apple who take all their profits, put it back into the company, and try to grow the company through their retained earnings. You compare that to, I don't know what comes to my head, AT&T, which has been around forever, flat to down. They try to pay a dividend every year. They're not really into the growth strategy. These are kind of the value stocks that I would think about. But the last 10 years, it seems like the growth have way outperformed to the point where I actually taught it wrong in my class last year because it was just so ingrained in my head. Growth stocks have been just kicking ass over the last 10 years that I forgot that historically, long-term, it's the value stocks that are winning. So anyway, if we were thinking about that, long term, then the play on that would be invest in value stocks over growth stocks. And so what we've talked about before as well with these small and large cap growth and value stocks, we said, well, no, it's not that markets are inefficient. It's that the model was faulty. So therefore, we came up with the Fama-French 3-factor model in addition to that beta measure that we originally had. So that's where we stand. But a couple other things have arisen since. Price to earnings ratios. Those companies that have low price to earnings ratios outperform companies that have high price to earnings ratios. Now, once again, this is in conflict with what we've seen in the past. I just checked yesterday. Tesla has a price to earning ratio in the 50s and 60s. Even Walmart's at about 35, 36. Netflix, these are all now with their haircuts in 2023. They got a nice haircut, a big discount here in 2022. So now these still high price to earnings ratios are now at least a bit lower than they were before. I was having a hard time even teaching fundamental stock pricing for the last 5 to 7 years because the valuations were just so out of whack that it was just the only way I could explain it is, well, it's called the greater fool theory, that if I buy Tesla at 600 and somebody that's foolish because the fundamentals say, well, it's a $200 stock. 600 is foolish unless there's a greater fool that is going to buy it from you at 700 or that you can sell it to at $700. And in that case, and when it just keeps going up and up and up, then you go, well, I don't know what to tell you. I guess do that until the party's done. But that's where, this bubbles and tulip mania starts to come about. So I'll talk more about that too when we talk about bubbles and crashes here later on in this semester. But nevertheless, low price to earnings ratios. I've been looking at a bunch. I do my stock screener through my discount broker, and I look at the low price to earnings companies that are paying a dividend. Now, I got burnt recently because I thought I'd found it good. It was Haynes. They've kicked my ass. Haynes, because they were paying a nice dividend and they were looking at it, but then here's the thing about dividends is that they can always take them away. So their next quarterly meeting, they said, we're done paying dividends, and everybody ran for the hills. It's like, that's the only reason we're in this stock is for this dividend. And it was about a $6 or $7 stock. And I just tax harvest it for just under $4 a share. So I will not only talk about my triumphs, but I'll talk about my failures as well. But anyway, as long as the board of directors isn't changing the dividend policy like that, I still like screening to earn income from those stocks. And then also find good value, what I believe in. So price to earnings ratio is essentially how much you are willing to pay for every dollar of profit. So for Tesla, people are paying 50 some dollars for every $1 of profit. We're finding ourselves now in an environment where I can find some pretty good deals, anywhere from $8 or 8 to 12. So paying $8 to $12 for every dollar of quarterly profit. I can live with that. So anyway, price to earnings ratios is the third one, and the play on that is invest in low price to earnings ratio stocks. There's a number 4, find really interesting, and this is tabled in the back of my mind to research. This is called earnings announcement momentum. So in particular, when a company comes out with their earnings announcement and it underperforms, there's a severe negative reaction. And what we've found is historically people tend to overreact. So the knee-jerk reaction is sell, sell, sell. And then when you kind of come to your senses and it comes back and it drifts back up. But here's the thing, it takes up to a month for this pricing to go back to equilibrium where everyone is satisfied with the new price. So of course, when we said all participants are assumed to process the information the same way, which means, yeah, if a negative earnings announcement comes out, everyone adjusts their price automatically. We all agree on that price to adjust. Some people win, some people lose, but the number is agreed. Here what happens is we get that severe overreaction, and then it pops back up over basically the next month. And so what I found is, and by the way, the overreaction stays down. This is the point where it's not just an overreaction bounce up. It's an overreaction trades way low and then kind of wakes up. And sometimes that takes up to a week for this to happen. So one of the things I've been thinking about is trying to prove this empirically, or at least go back and test this. So sometimes on the street or when I'm listening to CNBC talk about this 3-day rule. And I'm not sure if how many people actually use this, but they say if a market is down due to negative earnings announcements, wait 3 days for the carnage to happen. And so the intuition behind that sometimes does make sense. It's not just a negative emotion. Sometimes some people have to, large investors or institutional investors, if they're trying to get out, it takes time for them to do that. And that'll just make matters worse if they're trying to get out. Those who are on margin, who have leverage in the markets, they're also getting margin called, which means they either have to sell at that lower price and continue that price downward, or add more cash. And typically they'll choose the former. They will just sell out of that position and take their bath. But that drives the price down more. So the idea is wait 3 days and then buy it, and then hold for just a month just to see how that price bounces back. So anyway, one of the many ideas of floating around in this brain. And that's number 4. Number 5 is another challenge that is now recognized by a lot of the classical finance community, and this is called momentum investing. This is also one of my first paper that I ever wrote was on momentum. Happens to be the most downloaded paper that I have written too. So I guess lucky first crack. Anyway, momentum investing is essentially taking the previous good performers from the past 3 to 12 months and then just buying them, hold it for the next 3 to 12 months while that momentum is happening, and then sell at the end of that period. So the way you would actually execute this is if you have, let's just say we're looking at S&P 500 stocks. We have 500 stocks that we're looking at. And the original work on momentum, Yigitish and Titman, Sheridan Titman, I don't know Yigitish's first name, but they did this back in 1993. They did this, and they set this up taking New York Stock Exchange stocks, but I'm just going to set it up using S&P 500. So we have 500. We're going to take the top 50, so the top 10% stocks of the past 3 to 12 months. So just pick a number, 3, 6, 9, or 12. 3 to 12 months. And this is our formation period. So all we're doing is we're just looking at price performance, and we're ranking them from highest to lowest. And we're going to take the top 50 at the end of that formation period, and we're going to buy it. We're going to buy, and we're going to call this the winner portfolio. And then at the same time, in the original work, we're going to take the lowest, the ones that have been beaten down the most, and that has some momentum to it too. We're actually going to short sell them. Short selling means we're actually going to benefit from the stock going down in price. So we take the worst performers, and this is our loser, the loser portfolio. And so we're going to sell the losers. And for this to work out, and the way they set this up is you could take the proceeds from selling short the 50, buy the 50 equally weighted stocks of the winner portfolio, and they call this zero transaction. Nevertheless, the idea behind this is hold for 3 to 12 months and let this momentum take over. So the winners are going to continue to win. So it's kind of counterintuitive where we're supposed to buy low and sell high. Well, we're actually buying high and trying to sell higher, and we're selling low, trying to buy back even lower. But the momentum works. We can find here, I've writing it out. We've got our formation period here, our moment where we buy, the day that we buy, we'll call that T, today, and then we holding period of 3 to 12 months as well. And we just take the difference, and because we're doing equally weighted portfolios, we can actually calculate these returns fairly easily. And let's say the loser portfolio lost 10%, which means we actually gained 10% from that. And the winner portfolio gained 8%, which we were long anyway. So our net is an excess return of 18%. Well, I thought that was really interesting. And I felt like in my paper, what I wrote was, can retail investors, can they just use the winner portfolio, even with a small amount? I don't want to buy 50 stocks. I want the top anywhere from 8 to 10 stocks in the New York Stock Exchange. Would that work, even for a small amount? Because I realized that the loser portfolio, most retail investors, in my account, I can't short stocks. And if I did have the capability of shorting, there would be a lot of margin requirements. There would be a lot of fees in order to borrow on margin. It just doesn't work in a frictionless environment like this. But I said, what if I could just do winner stocks and hold these for a year, so 12 months, and see how that works? And I found, believe it or not, over the last 30, 40 years, I thought it was wrong at first, but it said that the monthly excess return, or the monthly return, was 3-point-something%, which means almost 40% per year if you were to execute this trade. And I was like, well, that's really interesting. After factoring risk, it still was a profitable thing. So I thought, it was a cool paper. I was pretty proud. And years later, I came back and was working on another project in a similar data set and was looking at it. And I happened to I just wanted to recheck momentum again in order to find the next research question, or answer the next research question. And I found for the last 10 years, all momentum is gone. So there's just no, when you divide it from the top 10% to the bottom 10%, like they did in the original work, found absolutely nothing between each, we call it deciles, 1/10. Each decile, there was just really no difference in returns. And so we wrote about that and we said, where has the trend gone? That we found no evidence recently. So this is the thing with some of these anomalies, that just because it's worked in the past doesn't mean that it's going to work in the future. And more often, people who learn about it as it becomes more noted in the world of finance, people try to exploit it. The more people try to exploit it, the quicker it goes away. That's the way these anomalies work. And we feel like people were just starting to use momentum and trying to exploit it. And through that process, kind of crush the whole benefits of doing so. So finally, that's momentum. And you can see momentum is 3 to 12 months, short-term momentum. It's been pretty robust, or it had been pretty robust in many different markets and many different securities, except for Japan, which nobody can ever find any anomalies in the Japanese stock market. The contrarian strategy, or this reversal strategy, is set up very similarly. However, it's going to be the opposite. And the opposite is going to be due to a longer time frame. So we're going to take typically the last 3 to 5 years now. We have the top performers and we have the worst performers for the last 3 to 5 years. We're going to rank them in the same order. But now, the ones who have performed the best over the last 3 to 5 years, we're going to say we're going to short those winners. And the rationale behind that is it's had its run now. Now it's time to come back to reality. So over the next 3 to 5 year holding period, it's going to come back to reality. And when it does, when we're short, when we have short sold it, that's going to earn us money. If we're a retail investor, what's going to interest us is more the worst performing stocks of that 3 to 5 years, because we can actually go long and buy those stocks and hold them for 3 to 5 years, knowing that it's going to return back to reality, or a reversion to the mean is what we call it. I like to just think of it as back to reality, where people recognize 3 to 5 years, hey, it's not so bad, it's had its momentum, and now it's time to come on the back upswing. Yeah. So that is long-term reversal, and that's the 6th challenge. There's some other ones, end of the day, or not end of the day, end of the week effect, end of the month effect, end of the year effect, January effect that we can talk about. But I'm going to wait to hear from you to see if that's what you want to hear, because, and we can do that in a future one. I'm going to finish out this section here, and we're going to talk about biases and heuristics next. But before we do this last part, we've got in this conversation market efficiency and arbitrage. Market efficiency and arbitrage. Arbitrage is risk-free profits. It's the holy grail of finance. And so what many people believe is, they say if pricing errors exist, there's dumb money out there, then smart money can come in and arbitrage that away until there's no free money left on the table. So there's a clever way. Hey, you want to put your 66, stupid guess in for the beauty contest. Well, there's a way to then arbitrage this. So you're just I can actually benefit from if you're paying into that, then I can arbitrage and benefit from your stupidity. Essentially what they're trying to say. But we've got 3 issues here in order for this arbitrage to work to get rid of this dumb money. This first one is called fundamental risk. This basically says that if you are actually trying to execute this, you need a perfect substitute in order to arbitrage, in order to make this a risk-free endeavor. So follow me here. If you believe Ford is underpriced, go ahead and buy it. Right? But if you wanted to use arbitrage, you would short sell the best alternative, or the closest alternative that you would have. So General Motors comes to my mind. I'm from Michigan, so this is near and dear to my heart. Ford, General Motors, sure. So you would short General Motors, and you'd use those proceeds to buy Ford. And when the mispricing goes away, because you believe that Ford was underpriced, that'll raise in price, you get out of that, you get out and buy back your General Motors, and you're done. So the risk is essentially riskless, as long as the mispricing goes in your favor and it works out the way you think. But there's still risk. It's not a riskless thing, even if that works. So the fundamental risk happens to be, Ford labor strike. Or General Motors labor strike, or there's a bad new CEO that comes that the street doesn't like, and it's going to drive this in different directions. So new information coming in, strikes. So it's tough to find this perfect substitute. And even if we do find a perfect substitute, noise trader risk exists. And so noise is an opinion on value. Noise is an opinion on value unrelated to fundamental information. So we've talked about fundamental risk, noise trader risk. I've always struggled coming up with examples of noise trader risk. I don't struggle with that anymore. Look at GME, GameStop. This happened last year. It's still trading at the moment at about 22. GME has never been profitable in the last, I don't know how many quarters. I've seen no plan. Commercial real estate, someone tried to tell me, wow, commercial real estate, it's the next new thing. I was like, what year is your brain in? Where are we at? This is commercial real estate's a disaster right now. And people are not really even acknowledging that fully. So anyway, we think about GameStop, and I said, I finally gave in when this thing, GameStop went to 400 at some point. And I go, what is driving this? And then I went to Reddit, and I got on Reddit, and I figured out Wall Street bets, noise trader risk. Hold the effing line, stay strong, buy the effing dip. Like, reading about this and people actually doing it. And I'll go back. Noise trader risk is an opinion on value unrelated to fundamental information. There were no fundamental reasons to be long, or certainly it was in the pandemic, or at the end of 2020, it was a $4 stock. During the pandemic, it was a $1 stock. End of the year, around 4 or 5 in 2020. And that's when the madness happened. It shot up to 400, and now it's still at 20 something. Hold the line. So anyway, arbitrageurs. Here's the issue. If you believe that GME is overpriced, which many, that's the hedge fund that they were going after, believed that GME was just about on its deathbed going bankrupt, and they had shorted the stock. And so, they think it's overpriced, short the stock. So you could short it, let's just even say at 20. But what happens, and the fundamentals say this is a $2 stock, so it should go down to 2 eventually. But it goes up to 40. What do you do as a short seller? Well, your bank is going to call you, and they're going to say, hey, you've got a margin call now, so what do you want to do about this? Do you want to add more cash to your position in order to get you back in the right ratio? Or do you want to get out of this position? Well, how do I get out of a short sale? You buy it back. Oh, so if I bought it back, I'm going to actually drive the price up even more. So that's what you call a short squeeze. Those who got shorted, they need to get out of their position to meet their margin calls. And now they're buying the process, and it's just further amplifying this mispricing. So that was part of it. So I think they took down, I can't remember off the top of my head what the hedge fund was, and so they were successful in this, but I can't help but wonder how many other hedge funds went in and saw it at 400 and said, I'm going to short the shit out of this thing and take it even down to 20 and close out. I wonder how many hedge funds compared to the one that went down actually benefited from GameStop. And then finally, there's the third and final issue to arbitrage exploitation is sometimes there are some hurdles. So like trading fees used to be the case, or commissions, If you have something that's in a liquid security, then you can trade in and out of positions or use this arbitrage, but your broker is going to be taking a fee or a certain fraction each time you do that. And so that in and of itself might take away the actual profits. Like I said too, there's short selling constraints. Like if you are a retail investor, it's not a frictionless zero transaction world where we actually have to put up 50%, 30% of our own money to meet the margin for trying to go short. And that's in a perfect world. And even then we would have to borrow at certain amounts. So even if you had $1 million, if we're at 4.5% or 5% as the base rate, they're going to take 5% plus 3 or 4. So you're at 8 or 9% just to borrow to have some margin. And then sometimes to move in and out of these things, think about tax implications, either foreign or domestic tax implications. So that's where sometimes exploiting this arbitrage just doesn't work very well. On paper, it seems really good, and academics like to talk about it, but the reality that we have here in behavioral are all these things that we just talked about. All right, so I've said my piece today about challenges to market efficiency, and would love to hear what you have to say. If you're excited to move on to biases and heuristics, welcome to the club. I'm right with you. I'm fired up and ready to talk to you about that. If you want to know more about these market efficiencies, check out, let me know. And so we can talk in later podcasts about this. Or you can go to brianfoltis.com, check out my papers. I've got them on I've linked in my CV on my website. You want to check that out. Want to say hi? Let me know. Say hi on my website or on Instagram. You can follow me. Please make sure you like and subscribe so you can follow me on future podcasts and learn more about behavioral finance. And if you need anything, let me know, or any questions that you might have. If you're looking to book me to teach your groups or your congregations or your business, I'm also booking for those as well. Would love to hear from you. Otherwise, have a great rest of your day, and we're signing off, and we'll talk to you later. Bye.